Tim, talk me through these numbers. What do I need to know? What's the instant analysis?
Okay, so we definitely disappointed. It was a bit of a surprise to me, but there's some pretty good movement here. First off, the supply side, the input side, is showing signs of getting better. Supplier delivery number drops considerably, which didn't help the PMI number. The second thing is that on the demand side, we kind of were flat, slightly contracting, but backlogs came down because new order rates aren't where we would like them to be. New export order rates are really low. Customer inventories are actually still in a very good place. But I think that whole demand side is really, we over-ordered and we're still trying to compensate for that. So the disappointing thing from my standpoint is that production didn't perform better than what we reported at 54. Now we had a seasonal factor that took a few points off because it's June. And then employment we're still struggling with employment. So overall, the summary on this thing is that we're moving in the right direction. It's just, the number is disappointing a bit because of the fact that we've over-ordered and we lost a bunch of gain there on the supplier delivery side. And, ultimately, we're looking for that production number to get back up to 58, 59, and the employment number to get to 52, 53. I don't think we're ever going to see a really hard, heavy employment number, though, unfortunately, at this point.
Well, Tim, you just said that maybe companies over-ordered and they've got to work that off. But does this suggest that it goes beyond that, that we're starting to see a slowdown in orders, slowdown in the economy, and manufacturing's going to slow overall into perhaps recession?
Well, I think we're seeing a slowing in order rate placements. But remember, the order books are still full, and people have ordered much more than they normally order in terms of time periods. So, and prices were still at record highs, but you can see that the prices are easing, which is a really positive thing. That'll probably get buyers back into the market to place orders. Nobody wants to place orders at high prices 1 year out and have to pay that high prices when prices were a lot less. So I think that's still the story. It's been the story for a couple months. Unfortunately, on the index side, the new order number came down because of that. But I think it's just really an adjustment and buyers waiting for those prices to continue to come down so that they can then, re-up on the order books.
Okay, let's just kind of go to the heart of what Mike is asking. Is there anything in here, Tim, that is consistent with the idea that the U.S. economy is heading towards a recession this year?
No. I can tell you that we had 17% of our respondents on the headline comments indicate that order rates are softening. But softening means normally when they have time, have an 8-time, there's 8-month rate. What I'm really watching for, back to Mike's question here, is lead time starting to come down. We've got prices easing, we've got suppliers delivering better, we've got employment, the ability to hire people is better, but we still have a turnover rate due to quits. The issue for me now is lead times. We're still at record CapEx and raw material lead times, and until those really start to come down, I don't think we have that, that really softening moment that people are predicting, and I don't believe we're going to see it this year.
Well, Tim, looking at the prices paid number and commodities reported up and down in price, still a lot of commodities rising in price, not very many at all going down in price, although the index dropped some. Oil prices over the last month have been falling, industrial metals have been falling, but it doesn't seem to be reflected in what your members are paying.
Well, we have about 10% of our respondents saying that prices are decreasing compared to, I think the number was 5 or 6% last month. We've had a steady progress in that area, not big, but a steady progress. And you can see it in the prices number. The commodity markets are definitely softening. The price of steel, aluminum, copper is all softening. The oil prices are still pretty strong, which is driving a lot of your issues on transportation and general energy stuff. So I think we're moving in the right direction here. I think the fact that demand was a bit weak and the fact that backlog got consumed is because people are not still placing orders at 2x the lead times. They're waiting for those lead times to come down and match better the pricing structure. So I think that's kind of where we're at this month.
Mike, let me just turn to you and just get your take on what is happening here. The US 10-year, the yield dropping fairly sharply as a result of the data we've just seen from Tim. How do you think the Fed will be reading these numbers?
They're going to be incorporating them in with everything else that they have seen. Now, the interesting question is going to come next Friday when we get the jobs report. If that were to come in significantly weak, then I think you'd all of a sudden have a rethink of this idea of 75 basis points at the end of July. Right now, it's probably still there. These numbers are still well above the recessionary levels, but the trend in pretty much all of the economic data we've gotten lately is slowing, if not significantly falling, and that has sort of built a recession view into Wall Street, and at some point the Fed may have to reflect that.
In terms of what the Fed is going to do, Tim, it is making it very clear, and we heard this from Powell when he spoke at Sintra, that the inflation narrative is one that they want to deal with and are firmly focused upon. How far away are we from an economy that you see being in balance between supply and demand?
Well, okay, so our production numbers have been pretty consistent, seasonally adjusted. We're running at a 54, 55 level here for the last 3 or 4 months. There's no decline in that, and that's really revenue. That's manufacturing revenue. And, you know, I did look, because the demand weakened, took a really close look at what's happening on the employment side. And by far, I still had 10-to-1 people hiring versus freezing and trading out to a different level. There's no doubt that people could. So if the panelists felt that we really saw a decline in demand, they'd stop hiring. And there's no evidence in the month of June that supports that. We did see a contraction on the employment number, but that's actually being able to put, you know, feet on the factory floor. The sentiment in the employment section for sure indicates that by far the majority of the panelists are still looking for people. So I think that's a positive thing. It supports the rationale here that we over-ordered and we have to compensate a bit for that. The new order numbers coming down, backlog is burning off. Production still hasn't reached its potential of 58 to 60. Employment at 52, 53 will be really good. The supplier delivery number coming off 8 points ultimately is good, but it hurt the PMI for sure.
Let me follow up on 2 parts of this. The prices and the employment in terms of, and this is probably going to be anecdotal, what companies are telling you, but are they expecting prices to keep rising, and are they expecting to continue to have to pay more to attract workers? In other words, is this wage price spiral showing any signs of beginning in manufacturing?
By far the headline comments is the price concern. There's no doubt about that. But we just recently did a survey through the end of the year, and our panelists predicted that right now we're sitting at 11.4% growth in prices since December of last year, and we think by the end of the year we'll be at 11.1. So we really think that we've kind of plateaued here, and that as we go through the second half of the year, we're going to come down very slightly, but we're going to end the year at about an 11% growth over end of last year's prices. So, and that's a fresh number. That was mid-May, so that's pretty current, and I don't think anything has significantly changed since then.
Tim, final quick question from me. We talk about manufacturers as if they are all one group. Are they, in terms of your data, are we seeing a spread between different areas of the manufacturing sector?
Yeah, so I track the top 6. It's computers, it's chemicals, transportation equipment, food and beverage, petroleum and coal products, and machinery, big capital intensive stuff. Our 2 strongest performing industry sectors this month of June, were petrochemicals, petroleum and coal products, refined products, and then followed up by chemicals. Computers. Computers is the number 1. I love to see that, number 1 and number 2 from a growth standpoint. That's really good. And there's no real surprise here that the refinery side is doing pretty well. And that's a positive too. So, you know, I think the weakest one is chemicals, and that is a foundational manufacturing product that goes into a whole bunch of stuff, from plywood to the concrete. And that's a bit weak. A little bit concerning. So, and I don't like to see it as weak as it is. It's still expanding, but not at a significant rate. But I'm very positive on the fact that computers and refined products did really well this month.